You're running a successful business and bringing in serious revenue, yet the cash seems to evaporate. Behind the scenes, bookkeeping is a reactive scramble, with a chaotic mix of personal and business receipts burying your desk. This lack of structure leads to a predictable result: overpaying the IRS for years. Without a clear system, you are effectively donating your hard-earned money to the government. For many entrepreneurs, tax season is a punitive, anxiety-inducing event, a stressful deadline to survive, rather than a system to manage. High-level tax strategy relies on a shift toward rigorous documentation and specific entity structures. This perspective transforms taxes from a source of friction into a calculated game of evidence. The IRS tax code serves as a giant instruction manual. It contains specific incentives for those who create jobs, invest in assets, and maintain structured business ownership. Business ownership becomes more profitable when you learn to read these instructions. By following the manual's requirements, you stop overpaying out of ignorance and start accumulating wealth. One of the most effective tools in the code is the S corporation. Using it correctly requires you to occupy a dual role. You are simultaneously a shareholder and an employee of your own company. This diagram illustrates the mathematical split the IRS requires. Your total profit must be divided into two paths: a W-2 salary and shareholder distributions. The W-2 salary portion is subject to standard payroll filings. This means federal and state payroll taxes are withheld from this specific stream of income. The remaining profit flowing through the distributions path is generally exempt from self-employment tax. This is the mechanical engine generating tax savings. If your business profits $150,000, you might set a salary of $70,000. That leaves $80,000 to flow out as a distribution, legally shielding that entire portion from the 15.3% self-employment tax. However, the IRS monitors the reasonable compensation of your salary. Setting W-2 pay unrealistically low to avoid taxes is a common trigger for a full audit. The S-Corp structure functions as a mechanical system designed to reward those who properly categorize and report their income. This advantage is lost without maintaining total separation between your business and personal finances. You must use dedicated business checking, savings, and credit card accounts. Mixing personal vacations with business spending destroys clean books and removes your defense during audits. Management must move from yearly panic to a weekly rhythm. Every transaction needs to be categorized and reconciled within your bookkeeping software to ensure accuracy. Documentation matters more as your deductions grow larger. A receipt labeled lunch provides no protection. You must log the specific business purpose and the parties involved to satisfy IRS rules. Mileage is a significant deduction that many owners lose by trying to reconstruct logs at the end of the year. Accurate tracking requires recording the date, destination, and purpose for every business trip in real time. Meticulous records are the only language the IRS accepts. Without a trail of evidence, your deductions can be disqualified instantly. A clean financial foundation provides access to advanced tax code strategies, beginning with the accountable plan. This plan allows your corporation to reimburse you personally for the business use of your home and utilities. This makes the expenses deductible for the business and tax-free for you as an individual. Under Section 280AG, the Augusta Rule, your business can rent your home for legitimate strategy meetings. This creates a tax deduction for the corporation while providing you with tax-free rental income. You can also employ additional levers, like hiring children for documented work or utilizing solo 401ks to significantly lower your taxable income. These strategies have clear boundaries. Personal luxury purchases do not become deductions simply by calling them business assets. Every purchase must have a documented business necessity. These advanced deductions represent the rewards offered to business owners who commit to the heavy lifting of compliance and documentation. At year-end, a financially organized business owner does not scramble. They provide their CPA with a synthesized profit and loss statement, a balance sheet, and clean distribution logs. Their operational rhythm includes reconciling accounts monthly and sequestering 25 to 35% of profits into a dedicated tax savings account to prevent future cash flow shocks. This level of organization creates a durable defense. It moves the owner past the struggle for survival, establishing the baseline for long-term wealth creation. The tax code contains a fundamental reality. Employees are taxed first on what they earn, but structured business owners are often taxed last on what remains. The manual is open, and the chessboard is yours to play.